Hello everyone. As I informed, I'm going to handle the accounting for financial instruments, including the impairment of financial assets and hedge accounting in IFRS subject. Here I'm handling three accounting standards: IFRS 9 or Ind AS 109, IAS 32 or Ind AS 32, and IFRS 7 or Ind AS 107. Recognition of financial instruments Ind AS 109, presentation of financial instruments Ind AS 32, and disclosure of financial instruments, that is Ind AS 107. So these three accounting standards are speaks about the financial instruments only. So let's see about what these accounting standards explains. Indian Accounting Standard 32, classification as a liability versus equity. Then offsetting the financial assets and financial liability. Under Indian Accounting Standard 109, recognition and derecognition of the financial assets and financial liabilities. Classification of the financial assets and financial liabilities, measurement of the financial assets and financial liabilities, and hedge accounting. And Indian Accounting Standard 107 or IFRS 7 will explains about the disclosure. Here, Indian Accounting Standard 32 and Indian Accounting Standard 109 both goes hand in hand. See, at the beginning, we have recognized and derecognize the financial assets. Then after, we are going to classify it as a financial assets and financial liabilities. Then we are going to classify it as a financial liability or financial equity. Okay. So in these classifications, three types: financial assets, financial liabilities, and the equities. So which type of asset it is, we are going to classify under Accounting Standard 32. Either it is financial liability or it is equity. Then measurement of the financial assets and financial liabilities. Then we'll go for the offsetting the financial assets and financial liabilities. At the end, hedge accounting. So I have explained about hedging already. So hedging is nothing but diversifying the risk by diversifying your investments. Okay. Then disclosure, how you are going to disclose these effects in the books of accounts or the final accounts. Fine. Let's understand one by one. Financial instrument. In general, it is a document which has the monetary value. Okay. But for the purpose of the Indian Accounting Standard, financial instruments includes both assets and liabilities. Here is the definition. A financial instrument is any contract that gives rise to a financial asset of one entity and a financial liability or equity instruments of another entity. So, the financial instruments either may be an asset or may be a liability. If it is asset for one particular company, that will be a liability or equity for another company or else another party. Here, a contract refers to an agreement between two or more parties that has clear economic consequences. Very important, clear economic consequences. The contract should be mentioned in money or in amount. Okay, and which parties usually are bound to adhere. So there is no chances of default, it assumes, because these agreements are enforceable by law. There is a law for these particular contracts. Chances of defaults are very less. Contracts need not be in writing and may take a variety of the forms. So contract means you don't think it should be in a writing. It takes a variety of forms. If you studied the contracts and the types of the contracts in business law, you can understand there itself. An important point to note is any asset or liabilities that are not contractual are the non-financial liabilities or the financial assets. So any assets or the liabilities, if it is not contractual, then it should not be treated as the financial liability or the financial asset. That means every contracts are not the financial instruments, remember. Each and every contracts are the non-financial instruments. So here are three classifications: financial assets, financial liability and equity. So common examples are here: cash, trade receivables, investments in bonds and deposits, then investment in equity. So these all are financial assets. And financial liabilities are here: loans and borrowings payable for the purchase of the goods and services, finance lease liabilities. Remember, finance lease, okay, not other lease, only a finance lease related aspects. Redeemable instruments like preference shares and debentures. Why redeemable? So redeemable means you have the liability to repay, correct? Only redeemable instruments, okay? Irredeemable instruments will comes under equity itself. Debentures, etc. Guarantee given for the payment of the debt upon the borrower's default. So this is the guarantee which is given by the company for some other person. So this is also the liability. And equity. Equity instruments issue warrants to issue the fixed number of the shares at a fixed price against the warrant. So warrants are also treated as equity instruments. Other instruments convertible into the fixed number of equity shares. So if there is any other instruments, as I said, the convertible preference shares, convertible debentures, these all are the equity itself. Financial instruments includes primary instruments such as receivables, payables and equity instruments, and even the secondary instruments like derivative financial instruments. Remember, derivative financial instruments such as financial options, futures and forwards, interest rate swaps and currency swaps. So we need to understand what is derivatives here itself. So I am not going in detail because in next sem you are going to study about the derivatives in detail. So this is the meaning. The term derivative stands for the contract whose price is derived from or is dependent upon on underlying asset. So this is the contract of buying or selling in future, and the price of the contract is determined on the underlying asset or one particular asset or the group of assets. The underlying asset could be a financial asset such as the currency, stock and the market indexes, and interest bearing securities or the physical commodity. Physical commodity we are not considering in IFRS subject, but we are considering in next sem's coming subject, that is financial derivative market. Fine. So directly let's go for the types of the derivatives. Forward contracts are there, future contracts are there, options are there, swaps are there. Okay. So let's understand what is forward contracts. These arrow marks are wrong here. Okay. This should be vice versa. See, there are two parties. One is a buyer, another one is a seller. So buyer will pay the money to the seller and seller will deliver the asset for the buyer. Okay. So if they are going to enter to the contract today itself, they say after 3 months they are going to buy this asset. So execution of the contract is in the future date. Okay. So remember, only two parties, buyer and seller here, that is called forward contracts. The next one is a future contracts. Here the clearing corporation or the statutory body or the regulatory authority will there. Okay. The only difference between forward contracts and the future contract is the middleman or the clearing corporations. Under future contract, there are two positions. One is a long position. A person who buys is in the long position, and short position, a person who sells. Then comes the option. So option is a contract where one party has the right to execute that contract and another party has the obligation to execute that contract. For example, if A and B are there, okay, and they enters for the option contract. So either A has the right to execute the contract and B has to do how the A says, or B has the right to execute that contract and A has to do what the B says. Okay, so this is just related to the contract in this time. Okay, so under option itself there are two types. One is a call option and another one is a put option. If any party entered into a call option, the buyer has the right. Okay, he is the holder of the contract, or buyer has the right to execute the contract, and another party has the obligation to sell that contract. So if one party buys, another party should sell. Okay, so under call options, buyer has the right to execute and another party has the obligation to sell the contract. Okay, and another type under the option is put options. Here the seller has the right to execute the contract, where another party has the obligation to sell that contract. So here the holder who is there, he should pay some amount to the person who is having the obligation. So that amount is called premium. Okay. So if the contract is executed or if the contract is not executed, so that decision is in the hands of the holder, correct? Whatever may be the case, execution or not execution, then also the person who is in the writing position or person who is having the obligation will get the premium amount. Okay, so this is about the option contract. We'll go for the swaps. This is nothing but a barter system. Okay, exchange. So it is an agreement between two parties to exchange the sequence of the cash flows for a set of a period of time. So it is like exchanging the debentures interest. One debenture has the fixed interest, another debenture has the floating interest. Likewise, okay, even about the currencies. Okay, the exchanging the currencies for dollars to Indian rupees. Likewise, fine. So interest rate swap is nothing but related to the interest of the bonds and debentures. Exchange rate swaps is, or currency rate swaps is nothing but the exchange of currencies. So this is the four types of the derivatives. Fine. Derivatives are also financial instruments. Okay. So under this, if a commodity contract, that is a derivative, is expected to be cash settled, it will be included in the definition of the financial instruments. So if any contract is cash settled, then it is a financial instrument itself. Okay. So under the derivatives, yes, this is a contract to deliver the asset or one particular commodity in future for the fixed price, which is determined at the time of entering the agreement. Correct. So here, if at the end or on the date of the executing the contract, if both the parties are agreed to settle the contract on the cash, then it is included in the financial instruments. That's it for today's class. In coming classes, we are going to understand what is the financial assets and what is the financial liabilities. There are some illustrations for that and even some of the examples. Okay, you need to understand this. We are not yet completed just a single accounting standard. We are just done with the introduction part.